Okay, what's up, everyone? This is Cash Flow Cart, Covered Call ETFs, and today we are getting real. Okay, I've got a lot going on in my head about this. Not to mention, I just recorded the video, take one, and I realized my microphone was muted after that video, so that's okay. The inspiration behind this video, and there's been a lot of it. There's been a lot of inspiration. I had to record this today. So, from my dad this morning at 12:41 p.m. QQY, 0-day option ETF. Ever heard of it? Sounds too good to be true. And I responded to my dad. I gave him my take on this whole aspect of covered call ETFs, and I decided I'm just going to film a whole video about it because I have a lot of opinions, I've realized, and not just opinions, a lot of things I need to bring into light. I also started a TikTok for the channel. I haven't posted yet, but I don't know. I might promo on there. I'm not really sure. And I just wanted to get a glimpse into what the world of dividend investing looks like through the TikTok lens. And I see some stuff why I never invest in high dividend stocks, as if a dividend stock that has a higher yield is necessarily a good reason to just avoid it for no reason, basically. I also see people showing like theoretical portfolios, kind of making claims, and including some of these covered call ETFs. If you invest 5K in this, you're going to make $550 a year, and we need to talk about this today. A few examples, since I am just referencing this from a broad perspective. I'm talking about covered call ETFs today. And if you're unfamiliar with any tickers of those, I've included a few over here. Some of these have been around for a while, some are newer. And then in recent times, we see companies launching these individual stock income ETFs. There's one for Nvidia, Tesla, Apple. There's an Amazon one now. And then ARK is actually one that tracks Cathie Wood's ARK flagship ETF. So, they're trying to take advantage of the elevated volatility in some of these names by offering a income option. Let's do a quick overview of what we're going to talk about in today's video. And I've already said I'm addressing this theme of a covered call ETF. We're going to start off with, what a covered call is and how simply calling these a covered call ETF could be a little misleading. And we're also going to talk about how these essentially work. And then I've included multiple misconceptions off just the top of my head. And we're going to go through all that. And then we're going to say, where could this fit into my journey? Where could this fit into a theoretical investor's journey? Where could this fit into your own journey? All right. Because we're all about passive income and wealth building on this channel. So let's go. So again, just to start off with this wording and calling these, investment vehicles, calling them covered call ETFs, it doesn't really sit right with me. It kind of rubs me the wrong way, I guess. So let's talk about what a covered call strategy would look like. It's going to consist of a two-part strategy, and you're going to purchase the underlying security. And then you're going to sell a call above the price of that security. So the underlying security is the coverage for that call. If it were to get called away from you, you already have that underlying security. Okay. So that's pretty essential to understand when we move forward with this video. And then here I've pulled up the top 10 holdings in TSLY, which, as I mentioned, was kind of this strategy only applied to Tesla. And if you guys look through these holdings, I'm going to give you a second, guys. Look through these holdings and tell me what you don't see. All right. What you don't see is Tesla. Okay. This is a income option strategy that tracks Tesla, but the actual position of Tesla stock is not one of the holdings. And you might say, how does this work? Well, let's move on. So, okay. This slide is a little bit wordy, but I'm going to be using the terminology synthetic covered call because, as we just saw, a covered call strategy in itself is owning the underlying security that you're using the strategy on. And many of these guys don't. Like these ETFs, they don't have that underlying security there. They create more of a synthetic version. So let's look through kind of how this works. First off, they're going to buy a call option and they're going to sell a put option. The strike prices of these options are going to be equal to each other and it's going to be equal to that current price. Okay. And these options will both have expirations down the line. It'll be in the future, 6 to 12 months out. Okay. And what this is going to do theoretically is going to create that synthetic tracking of that security. So for TSLY, they would have a call option at the current price and they'd sell a put. And then that would kind of create the tracking of that underlying security. I hope that makes sense. And then there's going to be a third option. They're going to sell a call option above the current price. Okay. So the strike price of this call option will be higher than the current price. And then they're going to collect this premium from that trade. And that's going to be partially what's used to pay dividends or distributions to shareholders of the ETF. It's very important to note that these call options they're selling are going to have a shorter term expiration than the piece of it that synthetically tracks the security. This might sound like a lot of boring stuff, but I promise as the video goes on, we'll make it a little more fun and interactive. And then with the remaining AUM that they have, they're going to invest in treasury notes, and the interest payments from these treasury notes is going to combine with these premiums, and that is what's used to pay you as a shareholder of this ETF. So as you can see here, we already looked at this top 10 holdings list for TSLY. Their biggest holding, over 50% of their capital, is invested in a United States Treasury note. Okay, misconception. Let's talk about them. This misconception. Okay, this will track the underlying security and pay me a ton of money along the way. Wow. Yes and no, guys. I mean, this is not the full story. So let's talk about what is the full story. It will participate in downside moves because that synthetic part of this strategy will be allowed to participate as the security falls. However, as the security appreciates on the flip side, there's going to be a cap. All right. So that covered call that they're using to collect income is going to create almost a ceiling in the short term for the price appreciation. And this is kind of a hard concept at first to wrap your head around. So I've included this. I mean, this one's talking about Ethereum, I guess, but I found this online. This green line here is going to represent the share price of our underlying security. And then the blue line, this flat part of it represents that cap. Okay, so let's say the underlying security does appreciate. You aren't going to be able to participate in, gains past that cap where you've got your strike price of the covered call. And with this in mind, if you can have full downside participation and you can only have a certain piece of upside appreciation in most cases, I want to ask you guys, is decay inevitable? We're going to look at a chart, but, I'm posing a question to you guys. So if decay is inevitable, averaging in to these kind of things, whether it's dollar cost averaging or just continually picking up more and more shares, it's going to be kind of a losing game because the price appreciation of the underlying security is not going to keep up, or the price appreciation of the ETF, is not going to keep up to the upside of that underlying security. So again, I feel like these are a lot of crazy words, but let's just look at a chart. So here we have QYLD. This is the Global X NASDAQ 100 covered call ETF. And I've shown this one in particular because it's been around since 2013. And as you can see in the share price of this ETF since 2013, you're kind of going to get a sense of, okay, that I see the decay now. All those words he was saying, it makes a little more sense when I can look at a chart and kind of visualize it that way. So versus we'll look at the NASDAQ here, QQQ. Since 2013, there has been a lot more share. There's been share price appreciation. Okay, so that's kind of the trade-off I want you guys to think about here when you're deciding if some sort of covered call strategy is right for you. I'm a big analogy guy, so I hope I can explain this one to make it make sense. I saw this like a viral table thing, and I saw it on social media. It's supposed to look like, if you look down into it, it just goes forever. It's like a never ending type of thing. I don't really know how it works, but there's mirrors and such. And if you can bear with me here, that glass on top of that table is going to represent that strike price of, the covered calls used to collect premium. And then the never-ending fall in the table is supposed to represent your exposure to participating in downside. So, I mean, if this helps you wrap your head around this, then I guess I'm glad I included it. Okay. Now, the next one we're going to talk about is, look at this dividend yield. I'm going to be rich. And this is just not a good line of thinking here, because the yields you're going to see for these securities are going to be totally on a trailing basis. Okay. So they're going to take the sum of the dividend payouts in the past year, and they're going to divide that by the current share price, and they're going to spit out this yield. And maybe new investors might see this and think, wow, I've buy this now for this price. I'm going to make 7.35% return to me in the form of dividends in the next year. That's not really true, because this is a very actively managed strategy. Okay. So all these short-term covered call plays are having to be managed and put in place by the team that manages the ETF. So, you're basically betting on how well these strategies are going to work in the future market, and not the future market, but in the coming market. And really, just to drive that home, I've shown the distributions history and the yield for one of these income covered call strategy ETFs. I'm not going to mention the ticker because I don't know if I should, due to work purposes, but let's look at it. So as you can see here, I mean, at a glance, you can easily see that none of these none of these payments in the past year from this one are equal. In November of 2022, the dividend payment there was 61%. And then the recent one here was 34%. So, with that being said, it's not really fair to use some trailing yield metric like this to try and forecast what you're going to get in the future. Also, as I'm seeing this now, type ordinary dividend. Okay. So the dividends that come from these are going to be non qualified. Okay. So if you're not using a tax exempt account, you are going to be taxed at a higher rate on these dividends. Let's move on to the next conception. Okay, here we are. I'm a beginner and this ETF is super popular. It must be what I need. So, if you're seeing some of this content, they're just totally normalizing these ETFs like it's some sort of very beginner friendly strategy. And the truth is, this is not a strategy or a vehicle that is going to be beginner friendly. And I'll say, if you're investing in something, it is so crucial that you understand the risk of it and you understand really what it is, or at least have some sort of, familiarity with whatever strategy is being used in the ETF. With that being said, these ETFs are not wealth building vehicles, okay? Because of that decay we saw in the chart and because of that cap on upside participation, I just can't say that these are wealth building vehicles, okay? But what they are and what they could be is an income investment. I'm going to get to that in a second here, but do not mistake these two: wealth building vehicles, income investments. To me, using one of these ETFs is purely an income investment, guys. Understand that. So the only person getting rich here is the fund managers with all the cash inflows into some of these and all the new ETFs they're starting in this space. Let's move on. So where might this fit? With all that being said, there could definitely be a practical use for an ETF that uses this covered call strategy. And I'll tell you what, in my opinion, the practical use is going to be. And it's going to be income supplementation for a retiree. So someone who has maybe a nest egg built up and they want to get a higher yield on maybe a portion of that and they want to live off that income. Okay. So they're not necessarily reinvesting the income from that ETF back into it. But they just want to supplement income with something like this. I could see that being a viable case. With that being said, this should not exceed, in a larger portfolio, this should not exceed a 10% weighting at the most, because the point of wealth building is not only to have that income stream, but it's also preservation of wealth. At some point, when we're done with our nest egg, we're done collecting the income from it, I'm sure we all want to leave that to a future generation if we can. And again, this is not a wealth building type of strategy here, guys. So it's people who are looking to set and forget. So maybe they can lump sum something into this ETF and not pay attention to the actual share price of the ETF, simply just enjoy those dividend payouts. Okay. And they're going to be able to sleep fine at night because they're not watching maybe the share price of this decay. They're just enjoying the income. And then if you're like me, guys, I'm 22 or, whatever age you are. If you're in kind of the accumulation phase here, you're not living off dividends yet. For me personally, all the dividends I'm making every month, I am reinvesting those back into my best ideas, my best dividend stocks I want added, or my best positions I already have. I'm beefing them up, I guess. it's very rare that I'll take out, one of my dividend payments and I'll just put it in my checking. I mean, I've done it here and there, but I try to be disciplined and I try to use my dividends to speed up the compounding of my income. So we've talked a lot, we've hit on a lot of different things, but I also want to say, when will these work best theoretically? And that's going to be in a sideways market, guys. So whatever underlying security, the covered call ETF you're interested in, excuse me, sorry. Whatever security the covered call ETF is aiming to track, if it's moving kind of sideways, it's not really in an aggressive bull phase or an aggressive bear market, it's going to work best in this sideways market. I've heard it say, well, this is a hedge against a sideways market. And okay, I guess so. I guess I could give them that. However, what's going to happen in an aggressive bull market if you have this in your portfolio? And so let's say you have this ETF in your portfolio, you're enjoying the income. That's great. But if the market is kind of ripping aggressively, you're not going to be able to participate in that full upside exposure because of the caps created by that synthetic covered call strategy. And guys, I mean, I don't know about you, but if the market's doing really well, I enjoy watching my stocks, participate. It's good to see. And it can be discouraging if you're like, okay, I'm getting some income from this, but the share price is just not keeping up in this environment. And then let's talk about in an aggressive bear market. Okay. You will participate. You will participate if you have this covered call ETF. You'll participate as the market moves down. Okay. Because there's no sort of stopper there to the downside. Right. So, with that being said, that can also be discouraging because if you're in one of these and it's falling and the market's falling, you're still collecting that income, yes. However, in the back of your mind, it's going to be like, okay, this falls more and more. I'm not going to be able to recover with the market. I'm not going to be able to get back, to where I was. And that visual of QYLD hopefully really kind of illustrated that point for you guys. Again, let's talk broad here. Discouragement is not good in this game, okay? I love doing this. I love the passive income aspect of it, and enjoying this is essential. Okay. So if you're in something you don't fully understand, guys, and it's discouraging you, that's not going to be good. Okay. We want everyone to be in this for the long run. So someday you can fully enjoy, you know, the income from your portfolio. You can reap what you sow. I'm not a farmer, but you can reap what you sow, I guess. We want to avoid discouragement, and we want to avoid kind of major setbacks to our journey, and understand that with this type of strategy, there's going to be risk. And yeah, just make sure you fully consider any investment you want to get into. With that being said, thank you guys so much for watching. I had to get this video up. I had to get it off my chest, I feel. And if you made it this far and enjoyed the video, feel free to leave a like or leave a comment or subscribe. Again, thank you guys so much, and have an amazing rest of your day.